Hey guys, Freaky Finance here. Last week we looked at Aberdeen Asia Pacific Income Fund, a fixed income emerging market fund. So this week we're going to go back to a company, Johnson & Johnson. Most of you guys will be familiar with this one. It's kind of seen as a stable business, and we'll go through it and see if that's true. With most people would know like the brands Tylenol, Modium, Motrin, right? And those are all basically over-the-counter drugs, and those get captured in one of their three business segments. So specifically that one, since it's over the counter, it's consumer sales. But their actual largest business is their pharmaceutical, strictly pharmaceutical, so you prescription. And they also have medical devices. So I'm not sure how familiar you guys are with the industry, but that one is like your Medtronics of the world, the actual creating the medical devices, manufacturing. So we'll jump into the segment data, just to give you an idea of 2019 sales, just a split. So you can see about half are pharmacy. Consumer, which is what everyone knows, because that's what everyone sees, or most people would see, is actually the smallest, only 14 million of the $82 million pie. So not that big at all in context, but it's funny how that works in your mind when you think Johnson & Johnson. You actually think of the smallest business segment. So their main blockbuster drugs, there's quite a few actually, and that's good in a company that's seen as stable, which is what you'd expect. So Johnson & Johnson has 26 drugs that do over $1 billion. 12 of which do over $2 billion a year in sales. So that's quite a bit of diversity from being a specific drug player. So when you're in the pharmacy industry, or pharmaceutical industry rather, you have to be careful of generics coming off when your patent eventually ends, right? And then you have to compete on cost. So while you're trying to get your brand out there so you don't have to compete on cost. But usually there's going to be generic knockoffs after the patent life is over, which generally eats into your sales. So anyway, these are the main products, like the big products that make up the platform currently. Now we're going to jump into a few. I'm assuming most of you guys are familiar with Tylenol and Listerine, Neutrogena. Aveeno is getting up there. I think I just saw Jennifer Aniston yesterday on the commercial pumping that. That's a Johnson & Johnson brand as well. So they have quite a few big brands. I do want to point out their baby care. They did divest some of their baby care. So you're going to see a decline in that area as we go through it real quick. So let's just go through some of the drugs just to get an idea before we jump into the financials. So when I go through the list here, I'm just looking for $1 billion drugs. So this is as of Q3 2020 financial statements. You can see that Stelara is up there. Most of you guys might know that one because one, the name's easy to remember, and two, they advertise quite a bit of it lately. And you can see they've had pretty good growth year over year, 30% international, 8% US, 15% worldwide, and that's in the last quarter over quarter. So this is Q3 COVID quarter versus Q3 pre-COVID quarter. So pretty good growth, and that's what you should expect in the drug industry. I mean, it's not very discretional spending. If you need this drug, you're probably going to pay for it. And this is, I should go into the branches that the pharmacy is focused, or the pharmaceutical segment's focused on, and you can see that immunology is a big one for them, and so is oncology, so study of cancer. But we're going to start with just some bigger drugs. So you can see here at 5.5 billion in sales currently, 9 months into the year. And Stelara basically, well, now it has 4 indications, and you're going to see that with a lot of the drugs Johnson & Johnson does, or any pharmaceutical will do, is that they'll get a primary indication to get it approved, and then they'll branch out to other indications. So this one, Stelara, is currently good for 4. So Crohn's, ulcerative colitis, and anytime you see an itis, just as a shortcut, just think inflammation of. So psoriasis is up there now. That's Stelara. Another blockbuster. Let's go one that's actually declining. So everything, like I said, is based on patent life and competing drugs as well. If there's a superior product that gets developed, then all of a sudden your sales are going to go down. And you can see that happening here with Remicade across the board. This decline year over year, 15%, right? And then worldwide, 19% a quarter. And that's kind of weird as you see one drug going up 30%. Internationally, you have another drug going down 30% internationally, right? So Remicade is similar. This is the one that's declining, Remicade, and you can see the same indications or similar indications. So you have here Crohn's disease, colitis, and some arthritis as well. So this one actually rheumatoid arthritis. The other one didn't have that one. So they don't always overlap, but it's kind of how you should be thinking about drug life and how important it is, because if the company's not careful, once these drugs go off patent or a new better drug comes out, these sales are volatile. So while the company looks stable on the surface, underneath it there's things changing. That's the Immunology. So this one is quite a big drug actually. So that's 9 billion year to date, so about a billion a month worldwide for oncology. So again, this is a big segment for Johnson and Johnson, and you can see this drug in the oncology worldwide is at 3 billion, so about a third of its oncology portfolio. And this one is for type of blood cancer, not chemotherapy. So yeah, and it's just important to go through it and see, okay, what does this do? Does it overlap with its existing other products? And is there competing products about to be launched on the market? And how long is the patent life? So there's a lot involved in going through Johnson & Johnson. So when media just says, yeah, it's a steady company, you studied everything, stable, you should go deeper than that, because it's a stable company because they have so many drugs that they're offsetting each other during their patent life. It's almost like staggering a debt maturity schedule. It's the same idea. You're staggering your patent life with your drugs and then trying to control competing products as well. So if there's a competing product coming to market, you might actually try to acquire it just to protect your existing business. Anyway, so that's another big drug for them. Zytiga, so that's one that might have been advertised. I know I've been advertised for this one a bit. This is for prostate cancer. So again, this is in oncology, and you can see here pretty big decline. So year over year, 75% in the quarter in the US. So that's pretty big. And you compare that to the first drug I just showed you, that was up 46% in the quarter, right? So you get these big moves underneath the surface, because when I go through the annuals and even the quarterlies, you're going to be like, oh, it looks pretty stable. There's a lot of different types of sales, different products underneath. This is another cancer drug here, so it's another 3 billion in sales year to date, so another about a third of their oncology sales. So there's a lot of, if you were trying to analyze this company, you'd have to know quite a bit of drug knowledge and know the patent life to map it out. But yeah, you can just see how volatile it is, right? Like even here you have 22% growth year over year, at the same time you have 75% decline here, 30% decline here. But overall, when you look at the business, you can see it's growing quite a bit. Worldwide, they grew 13% in oncology year over year, despite COVID. So not sensitive to a pandemic, obviously. Though that's not necessarily the case. You're going to see the other segments. This is pharmaceutical drug part, about half the business. And you're going to see the effect of COVID in the other businesses, which is one of the reasons why I'm looking at it. They also have pulmonary hypertension, which has been growing quite a bit lately, so 14% year over year. And that's actually growing in all three of its drugs. Then you have cardiovascular. It's actually been a weakness for them. So even last year it was declining pre-COVID, and it's declining again this year. And that's mainly from this one drug. And here's another drug trying to reduce the risk of stroke and blood clots in people. Alright, so let's jump into the financials. So annually, so again, this is pre-COVID numbers, you see fairly decent growth in the pharmaceutical segment. So these are the three segments up here. Pharmaceuticals, the top one, it's their primary one. And you can see they had 10% growth in oncology, they had 6% growth in immunology, and they had a 10% decline year over year in cardiovascular. But overall, the net's out to 3.6% growth in their biggest segment, which is pretty good on a $40 billion number. Revenue medical devices, you can see the decline here. And again, this is before COVID. I do want to point out here they did sell their diabetes care, so, and that was about $1 billion in 2018. And you can see this thing is down about $1 billion, almost exactly $1.030 billion. So organically, it didn't really decline, but because they've been selling some of its businesses and managing its patents, I would view this as kind of, it looks bad, worse than it is, because they actually sold it. Here you can see consumer, again flat on the surface, but over the counter, so that's your Tylenol is up. Beauty was trending up before COVID, and then you had baby care, women's care decrease even before COVID. That's kind of interesting. They talked about how they divested some of their baby care, and I mean, I was looking at Nestle earlier just because they have Gerber's, and that one's been off. It's been really good for on the consumer product side, because everyone trusts Gerber's. So it's kind of interesting. With baby care, you kind of want to be a trusted name, and so I'm surprised actually that they got out, because Johnson & Johnson's pretty, most people regard it highly, right? They use all their products all the time, or Tylenol, Listerine, right? But yeah, anyway, so overall kind of flat on consumer. but underneath there's some changes that people aren't seeing probably if they're not actually going through the annual statements. Most importantly, when media says, hey, this is a stable company, you can see here what they mean. This thing moved $10 million on a $54 billion amount. So very stable. SG is favorable. That's important. So actually we're able to save, either that's through less marketing or cost saving. They're able to save $400 million on that line item. And interesting enough, they kicked up their R&D by about $600 million. That's quite the increase on a year-over-year basis. Most people would have like mixed thinking on R&D. R&D obviously looks bad on the month you're incurring it or the year you're incurring it because you have to expense it. But I mean, if you're investing in your pipeline of pharmaceuticals internally, then when you come up with something, then you're in a good place. So it's always good to see R&D, in my opinion, just to see them invest back into the business, and it helps, in my mind, mitigate that risk that eventually some of these drugs that they rely on are going to come off patent, and then there's going to be generics out there competing. I actually view R&D increase in this case neutral, but I think favorable. And again, operating income looks fairly flat, so they saved money in SGA, but they increased their expenditure in R&D, so they netted it out to be slightly above. But again, on a $20 billion number, an extra $30 million in operating income doesn't move the needle. Other expenses is a source of noise, so here you can see that even though technically operating income increased, their net income actually decreased, but again, by a very small amount relative to the base. And then share price, you can actually see increased in 2019, so a lot of the market did. But importantly, if I go back, and I'll go through a chart at the end, you'll notice that the Johnson & Johnson's been kind of oscillating between 120 to 155. It's getting close to the 155 level again, but importantly, it's been there for 3 years, whereas a lot of other companies have been able to keep going up. Johnson & Johnson's been kind of stuck in a range. They have been buying back shares, so the share count's been decreasing. Tangible assets are pretty interesting. So they have quite a lot in current assets. I mean, they had $17 billion in cash at December 31st, 2019. So going into COVID, and it's not as capital intensive, so it's a pretty big cash flow machine. They only had $17 billion in PPE, so net PPE, so they depreciate a lot of it already. And they spend $11 billion in R&D, so their PPE relative to both their cash, their current assets, and even their R&D spending is very low. So do have goodwill and intangibles, so that's when they're acquiring other companies. So I never like goodwill. So that's why I break it out here, because if you look at the balance sheet, you're like, oh my god, they have $150 billion in assets and only 28 in traditional debt. But I like to break out the two just to see what goodwill is. Technically somewhat an asset, but and intangibles are technically, especially in a pharmaceutical patent life, right? But I always break it out just because it's easier in my mind to treat it as a lesser asset. CFO, you can see cash flow increase. No, that's quite a bit of working capital adjustments in there as well, but really it's been stable. CapEx and acquisitions. CapEx is actually pretty stable as well. It looks higher, but that's acquisitions, so I just lumped the two together. So what is it doing with its cash? They put about $2 billion, maybe $2.5 billion a year back into the business in traditional CapEx. So you can see they do make quite a bit of acquisitions, and some years are very lumpy. Like I think 2017, I saw $35 billion, which is a big number for this company's cash flow, right? Anyway, free cash flow is pretty high, averaging about $15.8 billion. Dividends have been increasing, and share buybacks have been stable. So overall, out of the free cash flow, they're pretty much giving it all back to the shareholders after their acquisitions and after their capital expenditures and after their R&D. And that's not a small number, right? For $15 billion a year. In context, the market cap is almost $400 billion, so a fair amount anyway coming back. And you can see on the metrics side, it didn't move very much at all. It's actually very stable. From a PE perspective, it looked worse because the share price went up, even though the fundamentals kind of stayed the same. But that's been oscillating for between this, I want to say 22 to 25 times earnings for the last 3 years. So that gets me less excited because it's not like I'm taking advantage of a COVID sell-off like I would be on other companies we've talked about so far. Though one of the reasons why I am looking at it and why I'm making the video today is the recent quarter and what my head is kind of thinking. So here you can see again pretty strong growth. Like I said, that you're 3.6% annually. They're currently at 5% year over year on that number. So again, continued growth, specifically in oncology, up 13%, pulmonary hypertension up 14%, cardiovascular was down again, but not as much as it was in the past. Medical devices. So this is the interesting one. And I looked at Medtronic before jumping on this as well, just to try to get an idea of are people all saying the same thing. So you can see the revenue medical devices down. Q2 2020 was worse for this number, obviously. So what's happening here is people are deferring surgeries or any high deferrable procedures. So I mean, if you don't have to go to the hospital, you're not right now, and you're seeing that across all the segments, which is important because that's what you'd want to see if you believe in that thesis. Medtronic said the same thing, and you saw that in the numbers in Q2 and Q3. Unfortunately, Medtronic is already back up to where it was pre-COVID, so the market's already front running the idea. But you can see that this narrative of people pushing off procedures is true. So basically, I was trying to find different companies that maybe there's some upside and bottleneck, so like or pent up. It's kind of like pent up demand, I guess, but really it's forced pent up demand because what happens is when people put off surgeries that they need or procedures that they need, there's a reason why doctors are recommending them. It's not to make money, even though people might think that. It's they literally have a duty to care for you, and they're saying this is what you need, or else things are going to get worse. And what's happening when people are deferring these things because, well, they catch COVID if they go to the hospital, these problems snowball. So all of a sudden, I had maybe something small, minor. I decided not to go, and now it's a bigger problem, and then I'm going to have to spend more money. So I think what's happening here, not only are we going to see it snap back in this line, I think there's going to be an acceleration of growth temporarily, or at least that's my thought process. And then what might happen is that this stock gets excited, and then I just sell it. So that's kind of my thought on this one. Because once they see this pent up demand, analysts might start just extrapolating it, and then I'll just sell it into strength. But I'm trying to find different ways to play that because Medtronic, technically, their entire business line is medical devices, whereas Johnson & Johnson, you only have, what was that, 30% on that pie chart in that segment. So I'm still back and forth on that one. I did pick up GoodRx when they were freaking out about Amazon coming into the pharmacy with the Amazon pharmacy, and GoodRx sold off. I picked up some of that. This is as of yesterday, the close. But again, it's the same thinking. It's just there's going to be pent up demand for anything related to going to the doctors, and GoodRx is just a way to play a pharmacy pickup. So more people are going to go to the farm or to the doctor and get their basic prescriptions. So we'll see. Again, this is totally different from Johnson & Johnson. It's not like a valuation play. You're buying into the idea that this thing is going to take off because of this increase in traffic that I think is bottlenecked. And that's how I'm going to play that. Or that's currently how I am playing it, right? But anyway, that's the idea behind why I'm looking at it. Consumer goods is interesting. It's up again year over year, slightly, but you're going to notice oral care is up, which I thought was interesting. Over the counter's up again, which has been traditionally been true. And then, but you do have this noise from 12% growth in wound care, so they also sell band-aids and alcohol swabs and all that. So that's gone up during COVID. So that's kind of a counter trend versus what I'm thinking going forward, right? Because eventually that's going to normalize. But then you had, more importantly, baby care and women's health continue to decline, and that's been the case from last year as well. So I don't know if there's competing products here that are beating them. I know baby care, they talked about divesting, but something to keep in your back of your head, that is there something Johnson & Johnson is missing with women's health? Again, it's a small part of their overall business, but it looks neglected when I look on the surface level. COGS. So Johnson & Johnson scales pretty hard. They have a pretty high gross margin, as you can see here, 67%. So when they get an extra 300 million in sales, they're getting quite a bit more in GMV. So you can pretty much see that, well, COGS went up 100 million, revenue was up 350 million. SGA is fairly sticky. Went up 60 million. Again, Johnson & Johnson is taking up their R&D. And you're going to see some of this with COVID as well, because they do have that vaccine news that is going to come out. So that's market expecting in mid-January, not early January on this one. We'll see if that moves it, like if it's a worse, if the media wants to say it as the worst vaccine of the four, then the four primary ones that they've been reporting on. That could be interesting. Maybe it's the best one. I have no clue. It's probably going to have a better cold chain, but it might not be as efficient. Or effective. We'll see. We'll see what it is, and more importantly, we'll see how this reacts to it. If the media says, "Oh, it's not as good," and then this thing goes down, I'm gonna probably pick it up. Right? That would be ideal for me looking at it right now. Though again, it could backfire if I wait right now, since I don't own it yet. I don't know Johnson and Johnson. If say it goes up because of the vaccine, then just got my idea just got more expensive. So I don't want to buy into that. So I'm kind of wrestling with it, getting in ahead of the vaccine news or not. Personally, for me, for the long term part of this business, I don't view it as a source of value. And then you can see operating income actually come in negative, even though GMD was positive, and that's that tick up 250 more million in R&D in a quarter. And again, these 2019 numbers were above 2018 numbers, so Johnson & Johnson's been ramping up R&D back to back. For Delta, though, you can see net income actually increased, but that's just noise because other expenses were down $3 billion. Don't read too much into that. Really, it's fairly stable. You can see that in the operating income and the underlying business fundamentals and gross margin has been improving. And that's been kind of hidden in the share price because this company's technically been improving these last 3 years, but it doesn't show it in the stock price. It's been oscillating. And we can see that here, though now it's at its high or near its high for the last 3 years. But unlike other stocks that have rallied or rallying in 2018, 2019, this thing is still in this range. So it's kind of interesting. I mean, it's a $400 billion company, so it's not small by any means. But yeah, they did take on some long-term debt. A lot of companies did. Anyone who was able to get, I've talked about this before, anyone who's able to get cash has, and they've got it at really cheap rates. You can see here the long-term debt was up 10 billion, but they increased 10 billion in marketable securities. So basically, they just borrowed $10 billion and stuck it in marketable securities. So basically, that just serves to increase tangible assets and increase total indebtedness. That's all that really happened here in the last 9 months on the balance sheet. That was material. CFO has started to bounce back. So I say that because Q2 2020 was the worst one. So this is Q3 2020 numbers. It's already starting to come back. Dividends paid fairly stable, increasing year over year. They did cut their share buyback, so this fully diluted share count didn't go down as much as it did last year. So they're protecting some of their capital. I'm not sure if they'll reverse that decision because this company is still raking in on quite a lot of free cash flow. And these cash flow numbers are 9-month cash flow numbers, not 3-month. So that's why they're bigger. You can see the operating margin here decline. A large part of that is because R&D was higher. As we saw, the GMD generator was actually higher on higher sales. So the operating margin looks low, but mainly that's because of their increase in R&D spending. So if you think R&D spending is good, then you don't really care. If you think it's bad, then you might care and be like, oh my god, the business is declining. But really, it's not. The GMD is strong. Sales are still strong, and that's despite the medical device segment actually declining because of COVID. And again, my thinking is the strength in the business is hidden in the decline in medical devices. And actually normalize and reaccelerate after COVID when people start going back to hospitals for more typical procedures and not deferring them. And finally, the debt schedule. I just like to bring this up because I always find it funny. All these little, I don't know if you guys can see that, but I'll try to make it bigger. All these little ones are basically just the means that they were new debt taken on in the last 9 months. You can see here that the interest rates, so in this 2025, they got debt at 0.55. 2027, so 7 years out, or about to be 6 years out, 0.95. And they were able to issue 2060 bonds at 2.45%. And that in my mind, I'm like, oh my god. Because if you bought that bond, right, you get your money back in 40 years. Technically, how I read this in my mind is you get your money back in 40 years, you get your 2.45% a year, and you have unlimited inflation risk. And then even after tax, your income is what? Say if you're in a 30% tax, you're getting 1.8%. Inflation's already a bit now, supposedly. I mean, I feel like you're getting nothing on that. It's an interesting time for cheap money. If you can get money, you are getting money right now. And you are getting it at very attractive interest rates. So it'll be interesting to see because this WACC has already started to go down. So you can see here, weighted average effective interest rate is now 2.85%. That's pretty low. And I think on the annual 2019, so 9 months ago, this was at 3.15. so they're able to get their discount rate down technically 10% in relative value terms, only 0.3% in absolute terms. But anyway, it's interesting to point that out because I've seen that over and over again with these big, large companies that are seen as stable. They have been getting some pretty good deals on debt. Though at the same time, what they could not be thinking about is negative interest rates. Then it's like, well, why did Johnson Johnson borrow at all when they could just borrow at negative? But anyway, well, that's a story for another day. I'd like to know your thoughts on Johnson and Johnson. It's a different one that I'm used to. I don't own it yet. I'm still thinking about it, and I do think that people have been putting off care, and that will lead to more care being required, more money being spent per person. And I think that's just a side effect of people deferring things that maybe you can't really say they shouldn't have deferred them, but I mean, when you're scared of COVID and getting a disease, it makes sense, right? That they're deferring it for a reason. But I think a part of the cons of that for the individual person is that they're going to have more problems when they go to the doctor. Things usually don't just fix themselves. So anyway, I'd like to know your thoughts on Johnson & Johnson, on just general thinking. And yeah, have a great weekend. I guess next weekend we're going into Christmas. I don't think I'm going to do this on Boxing Day, but we'll see. I do this, obviously I like doing it, so I'm going to keep doing it. But anyway, have a great rest of your day.